Understanding how to handle taxes for your single-member LLC can save you money and prevent headaches with the IRS. If you own a single-member LLC, you need to know that the IRS treats your business differently than other business structures. The IRS classifies single-member LLCs as disregarded entities. This means your business is not considered separate from you for tax purposes. Your LLC's income flows directly to your personal tax return, similar to a sole proprietorship. When tax season arrives, you'll report your business income and expenses on Schedule C, which attaches to your personal Form 1040. This form details your profit or loss from business activities. If you work from home, you might also need to complete Form 8829 to claim home office deductions. As a single-member LLC owner, you're responsible for self-employment taxes. These include Social Security tax at 12.4% and Medicare tax at 2.9%. Unlike employees who split these taxes with employers, you pay both portions. However, you can deduct half of your self-employment tax when calculating your adjusted gross income. High earners should note that an additional Medicare tax of 0.9% applies to income above $200,000 for single filers or $250,000 for married couples filing jointly. Since no taxes are automatically withheld from your business income, the IRS requires you to pay estimated taxes quarterly. These payments are due on April 15th, June 15th, September 15th, and January 15th of the following year. Use Form 1040-ES to calculate these payments. Failing to pay enough throughout the year can result in underpayment penalties. One advantage of operating as an LLC is the ability to deduct legitimate business expenses. These deductions reduce your taxable income. Common deductions include home office expenses, business travel, meals with clients, advertising costs, business insurance premiums, office supplies, and professional services fees. Keep thorough records of all business transactions, maintain separate business and personal bank accounts, save receipts, and document business purposes for expenses. This documentation is crucial if you face an IRS audit. Beyond federal taxes, your single-member LLC may have state tax obligations. Some states impose annual franchise taxes or fees on LLCs regardless of profitability. California, for example, charges a minimum annual franchise tax. Other states may have gross receipts, taxes, or state income taxes that apply to your business earnings. If you want to potentially reduce your self-employment tax burden, you can elect to have your LLC taxed as an S corporation. This requires filing Form 2553 with the IRS. As an S corporation, you can pay yourself a reasonable salary and take additional profits as distributions, which aren't subject to self-employment tax. Alternatively, you could elect C corporation taxation by filing Form 8832. This might benefit high-income businesses due to the flat 21% corporate tax rate. However, C corporations face potential double taxation, with profits taxed at both the corporate level and again when distributed as dividends. For most single-member LLC owners, maintaining the default disregarded entity status provides simplicity and tax advantages through pass-through taxation. Your business profits are taxed only once on your personal return. If your LLC has employees, you'll need an employer identification number and must handle payroll taxes. This includes withholding income taxes and both the employer and employee portions of Social Security and Medicare taxes. When hiring independent contractors, you'll need to issue Form 1099 NEC to report payments of $600 or more during the tax year. Tax rules for single-member LLCs can be complex and change frequently. Consider consulting with a tax professional who specializes in small business taxation to ensure compliance and optimize your tax strategy. A qualified tax attorney or CPA can help you navigate these requirements while maximizing legitimate deductions. Understanding your tax obligations as a single-member LLC owner allows you to focus on growing your business while staying compliant with federal and state tax laws. Proper planning and record keeping can reduce your tax burden and help your business thrive.